Good morning, good evening, wherever you may be, across the nation or around the world. My name is Shane Squark, and on behalf of the CMT Association, I am pleased to welcome you back to another webcast as part of our educational web series. Today, on May 29th, 2019, we are pleased to welcome Rob Koifman as he presents Probabilities and Price, Using Fundamentals to Enhance Technical Research. Rob is the co-founder and CEO of Koifin, which provides investors with tools to research stocks and follow market trends. He started his career at Goldman Sachs Investment Research in 2002 and later transitioned to a proprietary trading role in London. Following that, he worked as head of macro and thematic trading strategy at Citigroup and worked as a strategist at Caxton Associates, Leixer Asset Management, and Techni Capital. Rob started Koifin in 2016 because he was frustrated with the analytical tools available to most investors that don't have access to Bloomberg. As always, we welcome you to submit your questions throughout the duration of today's presentation using the chat box to the right-hand side of your screen. In the interest of time, however, we may not be able to acknowledge all of your questions until the end of the formal presentation. Your participation in today's live webcast does qualify you for 2 CMT Association continuing education credits, which will be automatically added to your account if you registered online through the CMT Association website. With that said, it is without any further ado, I am pleased to turn the floor over to Mr. Rob Koifman.
Thank you so much, Shane, and thanks for joining us today to talk about fundamentals and how to use them in conjunction with technical analysis. The roadmap for our presentation today and what I'm going to talk about is going to consist of 3 kind of main things. Just want to quickly touch upon my background, and Shane already mentioned some of the places I worked at. The second thing I wanted to talk about is kind of the framework or how I think about fundamentals and technicals and how they interact and work together. And the third, really the crux and the meat of the presentation is really how to incorporate fundamentals and high-frequency indicators into a technical analysis framework. And for that last part, we're just going to break it down into sort of 4 subsections. And I'll be talking about each one of these as a conceptually and also provide you with some examples of how I think about it. So the first thing is really how do you understand fundamentals from a macro point of view or from a big picture point of view. What are the macro drivers? What are the cyclical drivers of fundamentals and how you can think about those and how you could see those from a big picture perspective. The second thing is valuation. Valuation is really, really important. So for us, we're going to focus on valuation as it relates to multiples. Valuation could be this concept that can get very deep and advanced, but multiples are very effective and a quick way to think about valuation. The third concept is really thinking about Wall Street expectations and how do you measure Wall Street expectations through EPS revisions and analyst price targets. And more importantly, how do you measure the change in expectations, which is really the heart of that concept. And the fourth thing is really positioning. So how do you think about positioning? How do you measure positioning? And again, how do you think about the changes in positioning? So let's get kind of started with my background. I just wanted to let you know or give you some color on how I ended up being here today. So I was on Wall Street for a long time, for about 15 years. I started in Goldman Sachs single stock research and then moved to a group called Portfolio Strategy, which looked at the market from a more top-down and from a relative basis versus sectors versus subsectors. And then I also worked on a prop desk. And there I was exposed to just very fundamental research, kind of your traditional thinking about fundamental drivers, thinking about modeling, and all the concepts that go together with fundamental research. I then joined Caxton in 2008, 2009. So Caxton is a macro fund. That was really my first exposure to technical analysis. As many of you know, that macro and technicals go hand in hand with each other, and that's really where I started to think about technicals, where I started to learn about technicals. And I was there during a really interesting time in 2008, 2009. So March and April of 2009 was probably the most intense time to think about the disconnect between technicals and fundamentals, when fundamentals were super negative and it looked like the world was going to end, and technicals were very bullish and the market was sort of saying that there was a turn. And that was a really interesting place to learn technical analysis at Caxton at that time. Then I joined Citigroup and worked with ETFs and options, so thinking about macro ideas and how to implement them in ETF and options. Then I worked at Lixor Asset Management, which is part of SocGen, thinking about macro strategy and asset allocation. And my last job on Wall Street was at Techni Capital, which is a TMT fund, and I was focused on helping a portfolio manager do everything from risk to single stock selection to hedging to portfolio management. I started Koifin in 2016, basically as because of a problem I had that when I was researching ideas, when I was trading, I just didn't find the resources and the tools that I thought did the job well. And so that's where I am today. So the takeaway from my background, I'd say, is one, that I can't keep a job for very long, and then two, that I've been exposed to a lot of different investment styles. So I've seen kind of how fundamental work is done, how technical work is done, how macro work is done, and I think that's really helped me bridge the gap or really understand how all of them are related together. So the way I think about kind of technical analysis and fundamental analysis is this diagram. I don't know if it's a very simplistic diagram, but I think a lot of people don't really, a lot of fundamental people don't understand technical analysis or don't understand where it fits in. I think a lot of technical people don't understand where fundamental analysis fits in. And this is a question that I get asked all the time, which is better, technicals or fundamentals? And the answer is pretty easy. Fundamentals are much more effective at predicting future stock returns. So if you think about that picture where you are here, you're that person smoking the cigar. The future stock returns are impacted by fundamentals, by future fundamentals. Really, and I'll show you kind of some examples of that. Very strong efficacy. So stock prices typically follow fundamentals. Now, the problem with that is fundamentals are really extremely difficult to forecast. So one is you need to have a very specialized skill set to think about fundamentals. And the second thing is there's just always something changing in the world. So there's a lot of known unknowns. There's a lot of unknown unknowns. And so things are always cascading and changing and impacting each other. So it's really, really difficult to predict fundamentals. Doesn't mean that people don't try, but it's super difficult. Now, on the flip side, in terms of the past or what we know today, momentum or technical analysis, which I think is a version of momentum, is actually one of the most effective factors to predict future price returns. Now, the problem with momentum is that even though it's better than a coin flip, or it's the most effective previous indicator we know, or using the known data we have, it's actually not that great at predicting future stock returns. So although it has some information embedded in it, it's definitely not as good as if you were able to predict future fundamentals. So one of the things that you can do, or one of the things that we'll be discussing here, is what do you do if you can't predict future fundamentals and you're using technical analysis? How do you sort of think about the in-between? And that's the stuff in the middle, that blue box in the middle, which is the valuation and high-frequency indicators. And so we're going to focus on kind of four things, as we said: fundamentals, valuation, Wall Street expectations, and positioning. On the first thing, in terms of understanding fundamentals, really key to just think about when you're looking at a company, to think about what are the macro drivers, what's the big picture trend of earnings and fundamentals, and how does cyclicality impact those fundamentals. So looking at some examples just to kind of prove to you, or just to illustrate that fundamentals indeed do correlate with stock prices. So one is really, really high level, big picture. S&P 500 returns, S&P for the past 150 years, since 1871. And you could see pretty clearly here that whenever you have a dip in earnings, stock prices typically follow. And whenever you have a rise in earnings, stock prices typically follow. You've had that over the past several years. And we're sitting obviously now at this point where earnings are at a peak, stock prices are close to a peak. And really, as a fundamental analyst, your job is, or a job of a fundamental analyst is to really understand what's going to happen with earnings over the next 2 years, over the next 5 years, and that's really where stock prices will follow. But the big takeaway here is that stock prices do follow future fundamentals. Another kind of more micro example is here. I have a picture of Apple. So just thinking about Apple versus its earnings, and on the bottom here I have a drawdown from peak. So really interesting over the past 3 drawdowns between 30 and 40%. You've had the stock price, which I've highlighted in blue, peak before fundamentals. So the stock price peaked, it started declining, fundamentals declined. So it's not that fundamentals are following the stock price, it's that the stock price is sniffing out this fundamental decline before it happens. And obviously there's a probability associated with it at each point. But you could see here that at every turning point, the market was able to sniff out when fundamentals were going to turn, and which led to this kind of decline in this really long uptrend. So as an Apple analyst, or if you're following Apple, the big thing to remember is the big thing to think about is how are fundamentals going to evolve in the future with where is EPS going to go? Is EPS going to decline, or will EPS keep climbing? So getting into more specific macro drivers, it's really helpful to think about, and instead of just looking at the price versus the EPS, it's helpful to just look at kind of a big picture fundamental like revenue or EPS, and really think about what is the thing that's driving it, or and can you think about where that is in the cycle over the long term. So here I'm showing Lennar's revenue. Lennar is a home builder. It's one of the largest home builders, comparing it to housing starts. So as you would intuitively expect, housing starts drive a Lennar revenue, and they're very correlated and related. But then you start to see kind of where little things or things about the cycle that are interesting for Lennar. So again, we're trying to predict Lennar's revenue for the future, but interesting to note that here that one, housing starts and revenue have been rebounding since 2010. So that's number one. Second thing is interesting to realize here is that housing starts are actually in the middle of where they were in the previous cycle. So in the previous cycle, they got up to 2 million. Currently, we're in the low millions. So so it's not like we're at a peak for housing starts. So that could be another thing that informs your view of Lennar's revenue going forward. And then the last thing, my takeaway, at least from this, without going too deep into Lennar's drivers, is that Lennar's revenue is at a peak, even though housing starts aren't. So something is going on here with either margins or volume or taking market share, and that becomes an interesting way to think about Lennar and what it's doing with what's happening with the micro relative to the macro. Another example of looking at kind of big picture fundamentals versus some of the drivers. So here I have Schlumberger, which is one of the biggest oil services companies in the world, obviously correlated to oil prices because oil services, the business of oil services, correlated to oil prices. So more interesting observations when you take a step back. Oil prices peaked here in 2008, 2009. Schlumberger's revenue declined following that, but then they actually made a new high in 2015. So it looks like the drivers of Schlumberger revenue are oil prices, but there's other things going on there in terms of margins, in terms of market share. But really important to take a step back and think about what's the big picture, where are we in the cycle right now. Last thing on kind of thinking about fundamentals, I really like this example because it really gets into the heart of understanding the cycle. So here we are showing Micron, which is a semiconductor company, and on top we have Micron EPS, and on the bottom we have forward 12-month return. So basically, at every point in time, if you bought the stock, what would be your forward 12-month return? And you can see here Micron follows this really interesting pattern that if you buy the stock when Micron EPS is low, when it's at the bottom of the cycle, your return is actually positive. And when you buy Micron stock when EPS is at a peak, your return is actually negative. And the reason that happens is because Micron is a cyclical stock, and at the top of the cycle, you actually don't want to be long the stock, or you want to short the stock, and at the bottom of the cycle, you want to be long the stock. So this kind of taking a step back, looking at the long-term fundamental drivers of Micron and how its earnings behave really gives you a sense of when is it a good time to buy and short Micron, or where can you expect the stock price to generate very high or very negative returns. And right now we're just coming off of a cycle. We basically rounded a cycle where earnings had peaked. And obviously we don't know what the forward return is today, but we know that if someone had owned, or if you had owned the stock when the cycle was peaking, your returns would have been negative. And so my takeaway, or my hunch here, is that the Micron's earnings are going to, or Micron's returns are going to continue to be negative until we find this bottom in EPS. So again, if you're trading Micron stock, really, really helpful to take a step back and think about EPS and how it relates to the cycle and forward returns. So second thing I wanted to talk to you about is valuation and how to use valuation. So valuation is really, really important. It's at kind of at the core of what fundamental analysts do in terms of thinking about are you buying a cheap or expensive stock? And the concept of valuation could be very complicated. We could think about DCFs. We could think about risk premiums, and there's people that go to school for multiple years studying valuation. So we're not going to do that here. But the good news is if you use valuation multiples, you can get a pretty good idea and pretty good answer on what valuation is for a stock, whether it's cheap or expensive. So the way that I think about multiples is you want to, PE is the most common multiple, price versus earnings. 99% of the time, or 90% of the time, you'll want to use a PE ratio. When a company doesn't have earnings, you'll want to use a sales ratio or maybe an EBITDA ratio. But let's focus on P here for a second. And basically, when you have a P multiple, you want to do two things. You want to compare it versus its own history, and you want to compare it versus other stocks in the sector. And those are kind of two separate analyses. So if I tell you that a stock is trading at 15 times, that doesn't say if it's cheap or expensive. But if I tell you it's trading at 15 times versus its history where it's traded 15 to 40 times, then it's a cheap stock. And similarly, when I compare it to other stocks in the sector or other stocks in the market, if a company is trading at 15 times and other stocks are trading at 5 to 10 times, then obviously that stock is cheap. So a multiple by itself doesn't tell you anything. You have to compare it versus its own history and versus other stocks in the sector. The other interesting part about valuation multiples is they'll typically be a range where there's a support and resistance level for valuation multiples, and I'll go through some of the examples highlighting that in a second. So here we're looking at Apple stock price. Again, Apple for the past several years has been in a strong uptrend. If you look at the P multiple, right now it's trading at 15.6 times. Now, whether Apple is cheap or expensive versus its own history, on this basis, it's kind of expensive. So right now it's trading at 15 times. The prior 10 years it's traded between 8 times and sort of 20 times. So I'd say it's towards the high end of the range. Now, this isn't a screaming expensive stock versus history, but it's definitely not cheap. So the takeaway here, that's sort of in line to a little expensive relative to history. Now, the other thing to observe here is as Apple is in this strong uptrend, whenever you've had these pullbacks, these counter-trend pullbacks, you had the multiple bottom between 8 and 12 times. And you could see that here. So if I'm following Apple and I'm a technical analyst and I have no idea what Apple does or how to think about iPhone sales or services revenue going forward in the future, I do have this information that when Apple's PE or Apple's valuation falls below 12 times, typically that's been a good time to start thinking about buying the stock. So you can use that multiple in that arsenal to really add to your information on when to buy or when to sell Apple. Now, again, that second part of thinking about valuation, when is a stock cheap or expensive, comparing it versus other stocks in the market. So here I have a scatter plot of market cap versus PE. For the NASDAQ 100. And you can see Apple, obviously a very large cap stock, falls into here, cheaper than other stocks in the sector. So cheaper than Facebook, Google, and Microsoft. And if we compare it to some small cap stocks, it's probably cheap or sort of in the middle of the range. So on a cross-sectional or versus other stocks in the market, Apple actually looks pretty cheap. So another way of looking at Apple's valuation. Another stock that I wanted to highlight to you is Shake Shack, probably the opposite extreme of Apple in terms of being a stock with aggressive valuation. And we can look at it versus the history. And one thing to note here is Shake Shack doesn't have any earnings, so we'll have to compare it versus its sales. So on a sales multiple, it's trading at 3.3 times. If you look at the history, that's sort of in line with the history. So relative to the history, you'd say that Shake Shack is trading in line. It's neither cheap nor expensive. One thing I do want to point out is that this valuation multiple, the maximum valuation multiple has been sort of between 3 and 4 times, and that's been a good way to think about the peak, or a good way to think about where resistance level is for Shake Shack. So to the extent that you're looking to short the stock, this could provide you a good entry point for when to do that. Looking at Shake Shack just versus other stocks in the consumer discretionary sector, so we said versus its history, it's sort of in line. Looking at it versus other stocks tells you that Shake Shack is actually really, really expensive. So its market cap, this is versus the Russell 2000 consumer discretionary sector. Shake Shack is about a $1.5 billion company. So it's trading at really the top end of the distribution for price to sales, much more expensive than any other kind of consumer companies in the sector. There's only 3 companies that are trading at a higher valuation. So on a cross-section or relative basis, you could say that Shake Shack is expensive, and that's an important data point to keep in mind. One stock I wanted to highlight that kind of is interesting right now, which is maybe related to Shake Shack and that it's in the food business, is Beyond Meats. So Beyond Meats debuted or IPO'd about a month ago. We don't have a history to really think about how Beyond Meat has traded. So this EV to sales of 26 times, we don't have a history to say whether it's cheap or expensive. But remember, Shake Shack being more expensive than the other stocks in the consumer discretionary sector was trading at 3 times price to EV to sales. And Beyond Meat is trading at 26 times. So it really gives you a sense of how expensive the stock is. And when you're thinking about trading it, buying it, and in the future when we have more data, thinking about support and resistance levels. So moving on from valuation, wanted to talk to you about Wall Street expectations. So Wall Street expectations is this another indicator that's really interesting to follow. It's interesting to follow because we're observing Wall Street expectations of future fundamentals and how those are changing. And really we'll be focused on 2 things here. One is EPS revisions, and the second thing is analyst price targets. And so we'll really want to understand how those are changing, or what is the trend in those expectations over time. And that gives us a sense of whether we can expect future fundamentals to move up and down. And remember, this is a really great measure because you're observing the behavior and you're observing the output of analysts that are getting paid hundreds of thousands of dollars, if not millions of dollars, to do this for a living. And we're observing the change of those expectations, which is really helpful as a way to measure, are things getting better or are things getting worse? So let me show you an example of how to do that. So this is back to our friend Micron. Remember, this is a semiconductor company. So on top here, I have Micron stock price. On the bottom here, I have next 12 months earnings estimates. So at every point in time, this is what analysts are projecting for earnings for the next 12 months. And really interesting, you can see here that 2010, 2013, you had this huge rally off the bottom in 2009. The stock price was sort of moving sideways. It wasn't clear whether it's going up or down. And you had these huge rallies, kind of 80 to 85%, which obviously are massive tradable rallies. And what's interesting is that that forecasted earnings never went up. So the consensus estimates never really confirmed these rallies, which is a really important data point if you're thinking about, hey, is Micron starting another upcycle, or is Micron going into an uptrend? I'm not going to talk to you about the technical analysis here, whether we broke the uptrend or whether there's a consolidation. You can sort of use your own skill set and determine that. But what's interesting to do is kind of tie the technicals with the fundamental expectations to really say, hey, whatever Micron stock is doing, the fundamental expectations or the fundamental values metrics aren't tying into when the stock is rallying 80 to 85%. You can see that when the stock price did start rallying here, it was confirmed by increasing estimates. And when the stock price started rallying here, it was confirmed by increasing estimates. Now we're in this really interesting cycle where the stock is now entered a downtrend, or what I would argue now, a downtrend. Up until several days ago, Micron had rallied 53%, but you can see here that estimates hadn't really changed. So again, when thinking about did Micron break its uptrend, did Micron break its downtrend from a technical perspective, a really important piece of information is, are analysts changing their estimates, or are they increasing their estimates to the upside as a confirmation of what are fundamentals doing, or what are expectations for fundamentals doing. Another metric to think about expectations is the price target, is the analyst price target. So we just before looked at earnings estimates. Analysts also typically give a price target for their stocks 6 to 18 months out. And what you can do is you can actually track this price target versus the price. So again, we're looking at Apple here over the long term. One thing that you don't want to do is you don't want to use this price target as like, hey, the Apple analyst wants to, thinks that Apple is worth $180 or $200 or whatever it is. That really doesn't matter. What really matters is two things. One is where's the trend of the price target going? And then two is what's the percent difference between the price target and the price? And that's what I have outlined over here. So you can see kind of two things for Apple. One is when the trend of the stock is pretty strong, you have this price target that's confirming it. And again, it's not the level of the price target, it's the actual trend of the price target. The second thing is, what's interesting is during pullbacks, the change of the price target versus Apple's stock price kind of spikes, and whenever it's above 20, whenever it's between 30 and 40%, to me that seems like a really interesting opportunity to think about buying the stock on the pullback. So the things that I would want to do to buy Apple on the pullback is, one, I would want this differentiating factor to be above 30%. And two is I would want Apple's price target trend to keep moving up. So here we're at 20%, which is the difference between the current price and the price target. So I'd be looking for Apple to pull back another 10%. And I'd also want this price target trend to either remain flat or continue to go up. And that for me would be a really good fundamental signal, or a signal regarding fundamentals that Apple is an interesting buy on a pullback there. So another real world example I want to bring to your attention is Tesla. Obviously, this is a big, really important topic in the market. So right here, Tesla, there was, I'm not going to draw the line here, but there was a huge base that Tesla broke now. Analyst price targets have started to come down. This trend is definitely negative. And what's interesting here is that this spike, this percent difference, has started to become really excessive at 58% now, which is one of the highest levels it's been in over the past several years. So if you're short Tesla, I'd say this is a pretty good setup, or a pretty good indication of a continuing negative trend in terms of analyst price targets. If you have a positive view on Tesla, or you think Tesla is going to change the world, and Elon Musk just needs some kind of time to figure things out, then really what you want to do is wait till this starts evening off, wait till the analysts stop lowering their price target, and maybe think about a level that is really large in terms of the percent difference between the price target and the price. So last thing I wanted to discuss is Wall Street. Wall Street is positioning. Sorry, that's the titles there was wrong. Is actually positioning. So thinking about positioning from a short interest perspective and a hedge fund ownership perspective. So these are two ways to think about positioning in the market. Short interest is reported every 2 weeks, so we could actually see what percentage of a stock is shorted every 2 weeks. So it's not an indicator that gets updated every day, but it's a pretty frequent indicator. And then hedge fund ownership is another interesting concept. The only issue with hedge fund ownership, which I'll mention right now, is even though it's interesting to see what hedge funds are doing over as a trend, hedge fund ownership gets reported only once per quarter. So every hedge fund has to file with the SEC once per quarter, and there's a 45-day delay. So that indicator, although it's interesting and timely, it's not as frequent as some of the other ones. So just keep that in mind if you use that as you're using that. So I have an example here which I thought was pretty interesting for Boeing. So Boeing was in the sideways pattern for several years starting in 2014. Really obvious consolidation here with clear resistance. And then something happened in at the end of 2016 with the stock breaking out. Now, for as a technical analyst, this is a really clear breakout. But I think what adds to that from a positioning point of view is really seeing the short interest decline. So as the stock is breaking out here, short interest is going from this really elevated level to this reduced level. And so this trend of declining short interest is a pretty powerful indicator that positions are changing, or positioning is changing. And I think it gives you more comfort that this uptrend could be more powerful than if you didn't know that that short interest is elevated and coming down. So this is a great indicator to watch in terms of how is short interest, how is positioning changing, and is there a trend that you could observe in terms of short interest going from a very elevated level to shorts covering their position, or going from a very depressed level to investors increasing their short positions. The other indicator, or the other aspect of positioning, is hedge fund ownership. So here again with Micron's stock price, just as an illustration, you can see here that hedge fund ownership peaks and starts declining before the stock does. So hedge funds that are trading Micron actually seem like they're pretty good at timing the cycle. Maybe they use Koyfin and they look at the EPS chart that I mentioned before. But you can see hedge funds as a group, they're pretty good in terms of timing Micron. This might not work as well for other stocks, but this is a good indicator to think about as you're trading stocks, as you're thinking about stocks. What are hedge funds doing? Are they increasing positions? Are they decreasing positions? And where is that in the historical trend? But again, one thing I'll caution is that this gets reported once per quarter, and there's a 45-day lag, so it's not a very frequent indicator. The last thing I wanted to mention with positioning is I use positioning as a screening tool. It's a really cool way to think about where's there controversies in the market. So this is a graph of the S&P 500. Here we have the hedge fund ownership. Here we have the short interest percentage. And the stocks over here are really interesting to me because there's a high hedge fund ownership and a high short interest. So meaning that there's a controversy between the bulls and bears of where the stock is going to go. And whenever there's a controversy, that's where opportunities tend to arise in terms of taking the correct view. So here, this is actually Chipotle. Chipotle last year, at the end of last year, was actually up here. So really high short interest, really high hedge fund ownership. And as the bullish case has played out, the short interest has come down. So this was kind of a really interesting stock to follow as this has changed. But you can see this kind of collection of stocks that have high hedge fund ownership, high short interest. And I'd say if you're looking for ideas, or if you want to think about stocks that can potentially have a big move going forward, this is a great place to look and to start. So that kind of concludes my remarks about all the indicators that I wanted to talk about and to discuss. I wanted to take a second to discuss Koyfin and my company and what we're working on. So all the charts that you saw created in this presentation were created using Koyfin. The one caveat is that we have a big charting upgrade coming out, and that charting upgrade hasn't been released. So I'm able to use it because I work for Koyfin, but when you log into Koyfin, you won't be able to see some of the charts that I created. But over the next several weeks, you will be able to create those charts on your own. So if you create an account, and by the way, creating an account is free and using Koyfin is free, we'll send an email update when those charts or when that functionality is available. But just to kind of give you a quick pitch on why to use Koyfin or why I started Koyfin, there's sort of three things that we do really well, which differentiates us from other systems. So one is we bring together data all in one place, high quality data. So not only do we have stocks and fundamentals, we also have ETFs, mutual funds, economic data, bonds, FX, news, and Twitter. So you don't have to jump from 20 different websites to really analyze the market. We bring it all in one place. As you could see from the charts, the data we have is really high quality. So being able to grab valuations and short interest analyst price targets, that's all kind of data that you won't find anywhere else. The second thing is on the functionality. We've provided you with a lot of interesting functionality that has to do with charting, creating watch lists and dashboards. And so we really want to build the tools in Koyfin for you to analyze the data and not have you put the data into Excel and do your analysis there. So a lot of interesting and very powerful functionality to save you time from doing the analysis yourself in Excel. And then the third thing is we want to be accessible and intuitive. So accessible is we're web-based, we're free right now. In the future, we'll have a premium version or a paid version, but right now we're totally free. And intuitive means that we want to create a system that's super easy to use, that you could click through, that you don't need to kind of use a manual to start using it. And once you create a login and play around with it, you'll be able to kind of see that in action. So thank you so much for listening to that. Let me look at the questions and see if we have any questions. Okay. Why did you switch from, so question is, why did you switch from different jobs? Just curious. So I had a lot of jobs. I'd say depending on the job type, it was either a good opportunity or I had outgrown my job. So I'd say it was a combination of those two things. Sometimes it was kind of just the market or the situation just wasn't the situation that I wanted to be in. So I'll give you an example. As my last job, I was at Techni Capital. It was a great job. I really enjoyed what I was doing, but I had a role there that was a more macro and more strategist role that wasn't completely an obvious role that was the crux of the business, which is finding long short stocks. And we had some turbulence there in terms of our performance when I was there. And the market wasn't ideal for picking tech stocks in 2016. And so I decided that I wanted to look for something else because kind of my job as a macro strategist, as analyst at a TMT fund just wasn't going the direction I wanted to go. So that's one example. But really, it's always a combination of what do I want to do and what am I excited about and what's the opportunity set at the job I was at and potentially other job offers that I had on the table. What books do you recommend for your own personal technical libraries? Okay, great question. So the only technical book that I've ever read is Technical Analysis. I think it's John Murphy, and that's probably the Bible. I think technical analysis is one of these things where there's no solid definition. I think a lot of people use technical analysis in different ways. I like to think about technical analysis as a way to identify trends and trend reversals. And so I use it in a very simplistic way. I'll just think about, is something in a trend? Is it in consolidation? Is a trend reversing? And I won't use really more detailed indicators like MACDs and RSIs and all that stuff, because if you think about it, every single technical indicator is a function of price. So if you could think about where's the price going, is the price going up and down? Is that change accelerating or decelerating? You'll be able to kind of mimic or understand every single technical indicator out there. So for me, I use technical indicators very, very basically. What is the trend? Where is kind of the support in that trend? And is the trend reversing? And that's how I think about stuff. So from next question. For all those different variables, do you combine them in a quant screening score or follow an intuitive way? Great question. So I don't think about these variables as from a quant model because there's different ways of trading, right? So there's a quant way of trading, and there's also a discretionary way of trading. And my style is more discretionary, whereas I take all the pieces and I think about the pieces and I come to a conclusion. Sometimes short interest is the most important thing in my framework. Sometimes it's hedge fund ownership. Sometimes it's P multiple. So there's no one magic variable that'll tell you the answer. And that's why this job is so hard, because really the more experience you have and the more the more time you spend thinking about this, the more you realize that one of the things that's important is to really understand what is the important metric or what is the important concept for you to think about at that time. And that's, so to answer your question, I don't have one metric and I don't have a quant model to tell me or to be able to identify which is the important metric. And I'd say it's definitely an art, and it takes a lot of time to really bring all these variables together and to really understand when to use them. Global coverage of your stocks, does that include South African stocks? So right now we have US and Canadian coverage. In the next kind of short term, so hopefully in the next 1 to 2 months, we'll have global coverage, and that will include South African stocks, as South Africa does fall into the globe or into the world from kind of my latest recollection. Another question, you said you use the screening tools like short interest and hedge fund ownership. How come you name it last? How come you name it last? I'm not sure if I understand your question. Again, you may use any of these variables that you think are more important or less important. So, if you're an analyst that screens for ideas, maybe the screening tool is more important for you. If you're an analyst that has to identify, or you have you're a financials analyst and you have your financial stocks, and I don't think screening for those financial metrics would be, or for those positioning metrics would be as interesting. But again, please use the tools as you think they are important to you. There's no tool here that's better or worse than anything else. I've sort of presented to you the tools as I use them in general. And I've also focused on I've cherry-picked single stock ideas to illustrate the tool. But if you use short interest for a stock like Apple, you won't be able to, it won't tell you anything, right? So there are times when you have to use variables or these specific tools. There are times when these tools don't make sense or don't tell you anything. So what I wanted to do is introduce the tools to you to get them to, so they can be a part of your repertoire and your process, and then you can figure out when is the appropriate time to use these tools and when it works and when it doesn't work. Cool. So I think that wraps it up. Nope. I think we have one more question. Can you review your interpretation of recent dynamics for Apple and the price target data again, and what would you like to see occur with that data again? Okay. So let's go back to the Apple price target. Let's see. It's over here. Okay, so the way I would think about it is this way. Apple is in a long-term uptrend, and so I believe that Apple is, again, that's kind of my interpretation of the data. You could say like, hey, Apple has now started a downtrend. So I believe that Apple is in an uptrend, and if Apple is in an uptrend, I'm looking for I'm looking for an entry point for Apple. I'm looking when to buy Apple, and a good place to buy Apple historically has been when the price target has deviated from the actual price by more than 30%. All right, and you could see that that range here of being kind of like 0 to close to 50%. So for me, I'm not itching to buy Apple right now, because Apple, although it might be interesting, might not be interesting, that would be a really interesting entry point for me when this price gets deviated from the price target by more than 30%. So that would be a really interesting entry point for Apple. But then the second thing that I would watch for is that the price target is not going down, that the trend of the price target is up. And so those two things for Apple would need to happen for me to buy Apple in the context of a longer-term trend. If those things don't happen, meaning if these price targets start coming down again, or this difference isn't adequate for me, which is, I said 30%, then I wouldn't buy Apple. And that might be a mistake, but that's just how I would use the tool, or how I would use the this metric for Apple stock right now. Cool. And so with that, I'll turn it over to Shane. Thank you so much, everyone, for joining us today. Really appreciate you dedicating some time during this busy day. And I hope these tools help. And please create a free account on Koifin and use the tools. Thanks.
And on behalf of the CMT Association, I'd just like to extend our sincerest gratitude to you, Rob, for today's really terrific presentation. For those interested, today's presentation has been recorded and will be made available in our video archives over at cmtassociation.org. by the end of this week. If you do have any additional questions that we could not get to today or that you think of while watching that archive, please feel free to email them to me or any member of the CMT Association staff. We'll gladly pass them along on your behalf. I do encourage each of you to go ahead and check out Rob's website at www.koifin.com and create a free account and take advantage and see what Koifin has to offer for you. You can also reach Rob on Twitter at KoifinCharts. That will wrap up today's educational webinar series event for the CMT Association. My name is Shane Squark. I thank each of you for spending the hour here with us and hope you enjoy the remainder of your day. So long, everybody.